Hey there, welcome to Clear Money Talk, where we turn complex financial topics into clear, practical insights. I'm Tim Claremont.
I'm Tyler Andrews. Welcome to another episode of Clear Money Talk. Excited to be here. Tim,
Yes.
it's middle of the year.
Oh, great. Okay. Fast forward.
We are talking about today what should be on your mid-year financial checklist.
Got it. All right.
Very timely.
Yeah.
Many of you listeners probably found a lot of value in an episode we released at the beginning of the year. What should be on your new year financial checklist? So we thought this would be a good idea to take a step back and say, how are we doing so far year to date? We're about halfway through the year right now, and how are things shaping up based on all of those big lofty goals that we set at the beginning of the year for ourselves? So we're going to unpack some of that on today's episode of Clear Money Talk. Buckle up. Let's go.
All right, sounds great. A lot of things come to mind for me right now, Tyler, as I think about that mid-year checkpoint. A lot of times in the beginning of the year, you're thinking about, what did I just finish last year with? I'm going to have my taxes that I'm about to file in a few months, and you're typically caught up in some of the accounting of your financial situation because you're thinking about taxes and that whole New Year's resolution element, everything else. The mid-year checkup is just a good opportunity for you in general, in my opinion, to look back and see how have you done towards your goals and what do you need to do going forward to meet your goals by the end of this year. Because most people have goals that they've set for themselves, and without accountability, it's really easy to just let them slide and just reevaluate it next New Year's. So rather than doing that at next New Year's, this is a chance for you to say, hey, if I've accomplished all the goals that I had set for myself and I just want to, do I want to coast for the rest of the year, or do I want to reset my goals to accomplish even more? Sometimes we shoot our target, and we want to adjust that. Alternatively, if we're behind the eight ball and it just doesn't even look remotely realistic that we're going to be able to meet our goals, going through the next 6 months and beating ourselves up while we're not necessarily going to accomplish that is not the best way for you to handle yourself psychologically. So adjusting your goals if you need to make it realistic for you, I think is also an important part of this. I'll be excited to see the detailed numbers that we'll go through together. But one thing to keep in the back of your mind whenever you're setting any kind of goals for yourself, I'm always recommending that you make them SMART. It's an acronym, SMART. S, specific. M, measurable. A, achievable. R, relevant. And T, time-bound. So think through those a little bit. Specific, make sure your goals are specific, so it's very clear exactly what they are. Measurable, it's quantifiable. It's not something that's just like theoretical and intangible. Achievable, make sure you can actually accomplish it. Relevant, it has to have some kind of significance for you in your life. And then time-bound, right now we're talking about maybe by the end of the year, what are you going to accomplish? But you could think larger than that as well. Think of, by the time I reach retirement or financial independence, or for the rest of my life, I want to accomplish these things. Those are ways to set some other goals as well.
Yeah. No, well said. I love the SMART goals. And that'll be a lot that we can talk about today. A lot can change in 6 months, right? Especially if you're not paying attention. So the episode is not about framing about just reviewing the numbers. I want to talk about stopping in the middle of the year and asking ourselves, am I still on track financially? Or have I just been too busy in the day-to-day of my life to notice what has changed or what has fallen short or what has been exceeded? And that's everything that we'll talk about today. I think one of the most important things for many financially savvy listeners on the podcast is revisiting cash flow and spending, right? That's one of the biggest things. Yeah. Tim and I always talk about, you have income that comes in, you have expenses that goes out, and then left is leftovers. It's profit, essentially. And if you're running a deficit there, that can become a problem. And if you're running a surplus, that's good. But it's then about what do you do with that surplus? And we can talk through that as well. But a mid-year is a great time to check whether spending has drifted. Incomes may have changed. So have subscriptions. Maybe the subscriptions have changed. Travel, family cost, everyday expenses, those things often drift as they naturally do. Not everybody has a super fine-tooth comb on their expenses like Tyler over here with his spreadsheets. So the goal is not perfection, it's awareness, and that's what it's always about.
Yeah, no, that's smart. I appreciate what you just articulated, Tyler. It's a great parallel when we talk about businesses and the valuation of stocks or other companies. When we think about that, it's the revenue that comes in minus the expenses that go out. The difference is profit, and really profit is ultimately a determinant as it relates to how much a stock might be worth. When it comes to your personal finances, as Tyler was just saying, your revenue comes in your personal finances, your expenses go out, and then that difference is that surplus that you may have. And what you do with that is ultimately how you build your net worth. And the bigger your surplus is, the more important it is for you, of course, to make sure you're utilizing it as effectively as possible. Are you maximizing your return on your investments? Are you minimizing your taxes on the reinvestment of those proceeds? Where are you putting that extra money? And alternatively, if it turns out your expenses are greater than your income and you're going into debt, you're going to end up in a problematic situation that you need to avoid. And being self-honest, recognize that situation and say, hey, this is going the wrong direction is so critical. And this mid-year checkpoint gives you that opportunity to take a look and see, where that's at. Sometimes our own perception of our expenses is not really aligned with the reality of how we spend our funds. And the other thing to think about is expenses fit in two categories. You have your fixed expenses, and then you have your variable expenses. Those subscriptions Tyler was referring to can very quickly become fixed expenses that are just coming out of your paycheck on a regular basis, or your savings account or your checking account on a regular basis, or your credit card. And in reality, they could be variable expenses if you needed to do any kind of trimming. The variable expenses are the ones that go up and down depending on how much you spend that particular month. Perhaps some travel or food or things along those lines that might be more variable. Examples of fixed expenses would include rent or a mortgage payment, any kind of taxes that are going to be there for sure on a regular basis, like property taxes, for example, or other taxes.
Yeah, yeah. A quote that always resonates so well with me, and maybe it's less of a quote, but more so just a truism, is that your income is your biggest wealth building tool that you have. For 99% of Americans, holds true to this day, I think, when it comes to financial planning. So make sure that you're keeping a very close finger on the pulse with your income and your expenses, because that is your biggest tool to building wealth. That other 1% of people, it might not be the biggest tool that they have for building their wealth. It might be because they own a business or they have some other windfall. But for most people, your income is your biggest tool for building that wealth.
Well, and even when you do own a business or you have other income, usually that business is generating revenue for you, and that revenue comes in the form of an income, and utilizing that cash flow in an effective way to optimize rate of return and minimize tax consequences is definitely something that a lot of our high net worth business owner clients are very focused on. So I think your truism is on point, Tyler. Income is really one of your largest, if not your largest, tools to enhance and achieve your net worth goals.
Yeah, well said.
Yeah.
All right, so now we've reviewed income, we've reviewed expenses. What's next? Let's review your savings goals. Those goals that we set at the beginning of the year for whatever it might be, emergency funds. You had a goal in mind for getting your emergency fund up to the level that you wanted at for your comfortability. Maybe it's college savings for children or other important members of your circle, or maybe it's even for yourself for college savings. How are those coming along? Retirement contributions and savings. Travel funds. Some people set away money for big holidays, so that way they have that sinking fund set aside to pull from when that time comes. These are all things that you want to take a moment to say, how am I doing? Am I on track? Am I ahead of schedule? Or any adjustments necessary? Because last thing you want is to have that milestone be here and then not have saved enough to get to that point that you'd want it to be.
Yeah, I think it's good to talk about the savings goals, but I just realized that you're probably looking for some meat. You're going to say, hey Tim, what are the specific things that we can take away from this? And I'd love to give you some rules of thumb that'll help you as you're figuring this out. The first thing you need to do is, you break out your sheet, start writing your stuff down. When you're looking at the income and expense situation, target that. Take a look at your expenses. Write down everything that you've spent $5 or more on for a period of 90 days. If you do that for 90 days, you'll have much better clarity on what your actual expenses are like. Commit to doing that homework, and then commit to reviewing it and looking at it, and just be honest with yourself about what you're really spending your money on. Do the same thing with your income. Track what revenue you have that's coming in, and see how much income is coming in. Then you can start to look at the percentage of the two. In general, a good rule of thumb is live on 80% of what you're taking home. So now I'm not talking about your gross income before taxes. I'm talking about your net income after taxes are withheld. So whatever that net income is that's deposited in your account on a regular basis from your paycheck, presumably, or whatever other source of cash flow you have, that net amount, you should be living on 80% or less of that amount. And then that surplus differential of 20% that's left, you can ideally save at least 10% of that for long term, and maybe use 10% of that for those fun purchases, those things you might save up for, vacations, things of that sort. That's a good baseline for you to reach a certain level of positive net worth growth and some success. And what you do with the long-term savings, of course, we can assist in that respect. That's what we do. Listen to our podcast, check us out, and get more insights into how to invest that long-term savings. There's a lot of other podcasts we've talked about that on. And then, ultimately, what you choose to spend your money on for the shorter-term fun stuff, as we refer to it as your fun money, whether it's a vacation or whether it's your kids' college education that you want to set aside money for in order to cover that. Having fun, giving money to your kid for college is optional, but in general, it is considered fun money. It's a nice thing that you're able to do that if that's what your desire may be. But it's when you have that paycheck to paycheck lifestyle where you're spending 100% of your take home or close to it, that it gets really hard to get ahead. And I know you might say, Tim, you're an idiot. There's no way I can live on 80%. I get that. You could say that, and that's fine. And I understand. Like, the real world is the real world. It's hard. It's not necessarily easy to live on a lot of the income streams that a lot of people have to live on in today's day and age. But you have to draw the line somewhere. And if you draw the line at 80% and build your lifestyle around that, you'll be able to move your way towards more successful life choices and more successful opportunities that'll give you more, a better life. And that's a reality. If you can just carve down to that 80 as a minimum and say, I will live on this, I will make it work, have a little bit less than you could have otherwise purchased, and then do smart things with that 20. That's ultimately what can help get you to the next level. There's actually a book that I used to give to clients when their kids, when they would graduate high school or graduate college. And I would say, I don't want to go too far down this concept. The title itself may trigger a certain response based on your own religion or spiritual belief set. It's not my desire to align or misalign with whatever your feelings might be from a religious standpoint. But it's called The Richest Man in Babylon. And it's a good short book. It's a good short read. There's a lot of neat short stories in there that give some really neat practical story-based insights into how to save. And it's a pretty popular, common book if you want to check it out there. I'm sure there's some other books along those lines, but for me, that was a good one just to get some of those key stories in place and learn some of the basic things that that you can ultimately save in a smart way to reach your goals.
Yeah. Another great conduit for learning some financial literacy and education is Clear Money Talk. So
exactly,
if you don't want to pick up a paper-bound book, I get it. You can listen to Tim and I have a fun time talking about money stuff. So shameless plug for the podcast right there.
That's fine. We need more subscribers, so send this out to all your friends and hit the subscribe button if you haven't already. So that's
right. The more subscribers we get, the easier it becomes for us to continue to put out good content and share what we do here with all of you. So we appreciate you giving us a listen.
That's great. Thank you.
The next thing Tim is going to be really excited about, this one, is reviewing taxes before year-end pressure hits. So tax planning is often done better at the beginning or the middle of the year at the latest, opposed to the end of the year. Reason for that, if any changes are necessary, you want to have a runway, just like a plane. You want to have a long enough runway to land the plane safely. Same thing with taxes. You need to have enough time to allow for changes and implement those changes as needed. Now, a lot of the listeners probably are on some sort of a salary or an hourly rate where taxes are being withheld from their paychecks from their employer. So a lot of the hard lifting is done for them. But that's not the case for everybody, right, Tim? There's people that are self-employed, that own their own businesses, and they're actually in charge of withholding and maybe setting aside enough money throughout the year to pay their own tax bill. Or maybe you're doing quarterly estimated tax payments where you're having to pay 90% of the estimated tax bill for this year, or 100 or 110% of the previous year's tax bill. And all of those nuances and the nuts and bolts of doing that is often better done now than later.
Fair.
So, are withholdings still on track? Have incomes changed? Income sources too. Maybe all of your income is not derived just from gainful employment. Maybe it's from passive income. Maybe it's from investment income, dividends and interest and capital gains and things like that. Make sure all of those things are cohesive and working together and not working against you is the name of the game here.
Yeah, no, you're right. Yeah, you just opened a can of worms that I'm excited to go dive deep into.
And
go, right. So, I have to say that taxes is definitely one of my personal passions. It was my original ambition was to be a tax attorney when I was 12, 13 years old, and read the book by John Grisham called The Firm, which was just very enticing. But at the same time, I had also received my first paycheck. FICA and FUTA and Fed Inc. and Stat Inc. had taken a big bite out of it, and I asked my dad, what is this? Who are these entities, and why did they take my paycheck? And that's when I learned about taxes. So I was doing my own 1040 EZ literally at 12, 13 years old, because my dad was a frugal man and he was focused on running his own taxes on J.K. Laser's Tax Guide, reading that book every year. And he's like, you can do this, Tim, it's fine. So nerding out on taxes is something I can do. And I've done that previously on a lot of other podcasts. So I'm going to try to keep it tight for this podcast. If you're doing your mid-year check-in, Tyler's right on point with some of those 90% to 100% to 110%. So there's a thing called a safe harbor. And if you expect your income to go up significantly this year, or this year is a year that you're going to make probably more than you did the previous year, you should take a look at what the safe harbor is that you need to prepay in taxes for this year. And you can do that through either quarterly estimated tax payments or through withholdings from your paycheck if you have a paycheck. One of the nice things about withholdings from your paycheck is you can actually, that's automatically treated by the IRS as if it's been received evenly throughout the year. So if you have a big deficit between maybe how much you should be withholding for your taxes versus that safe harbor number, you can actually have a significant increase in your withholdings done out of your paychecks, or even maybe a big bonus if you have a bonus coming up between now and the end of the year, and still make up for the fact that you didn't pay as much in those estimated tax payments as you theoretically should have when they were due in April and again, right now, so roughly mid-June. So if you're looking at trying to catch up, one of the ways to do that is to increase your withholdings from paychecks. And if you don't have paychecks, because that's just the structure of your situation, you're self-employed, and maybe you have everything coming in as distributions, then you want to catch up those estimated tax payments to get on track. If you end up owing money for the previous year and you didn't pay it, and you owe more than $1,000, you get hit with interest by the IRS and the Oregon Department of Revenue. They're going to say, hey, you should have paid this sooner, and because you didn't, you're going to have to pay us interest on this. And then that interest just becomes an additional expense, ballooning your tax bill into an even larger amount of money, which you would rather not have to pay. If you pay the safe harbor amount, and you can look into this, just Google it or ChatGPT it or whatever, what your safe harbor is, it's somewhere between, it's typically 110% of the previous year's tax bill is a good minimum, or maximum number. That's the highest it would be for you. It's possible your safe harbor is a little lower depending on where you're at. But worst case scenario, you could say, what did I owe last year in taxes? What was my taxable income for the previous year? What's 110% of that? If I pay at least that much this year, I won't have to pay the interest on having paid late. You might have to write a big check if you make a bunch of money and you pay it next year, April 15th, when you file your taxes, but at least you won't have to pay the interest on it because you paid enough to cover the safe harbor. This is a big deal for people who have a big increase in their taxes. On the other hand, if you expect a decrease in your tax bill this year, maybe you had a huge year last year and you're thinking that this year's not going to be as high, your withholdings may be significantly greater than they normally are. You may have prepaid enough to cover your tax bill, so estimating your tax consequences this year and saying, hey, maybe I've already paid enough in, that might be real. And if you have already paid enough in, you might be able to adjust your withholdings between now and the end of the year and actually have more money coming back to you right now in your paychecks. That's one of the things you should double check and run some numbers on. I'll try to keep it simple there, but there's a lot more on taxes, especially if you're in Oregon. The Multnomah County income tax, when you have to deal with that, the City of Portland, if you have a business in the City of Portland and your revenue is coming up at a higher level, you have City of Portland business tax. Then you have the Oregon corporate activity tax, the CAT tax, and then of course you have your Oregon Department of Revenue as well as your federal taxes. And you can even have the Medicare surtax, or also known as a net investment income tax, that can hit depending on where you're at income-wise. So legally minimizing your taxes is a passion of ours. So we're all about that wherever we can.
Well said. Well said. Tim, thank you for the tax nerdness there. We're going to move on to revisiting your protection and risk planning. That's insurance. Revisiting insurance. Not fun, right? Insurance is not a sexy topic usually to talk about, but it's important, right? So that's things like reviewing. Tim's got it.
I'm just visualizing this little cartoon dancing sexy character that says insurance with like some kind of a banner on. Anyway, whatever. Point. Yeah, it's not very sexy in general. Insurance is not
usually not.
But yeah, good point.
It's necessary. So reviewing insurance coverages, reviewing beneficiaries. But it goes beyond that. It goes to reviewing estate basics. So your estate documents, is your will and your trust in order. That's usually something that we recommend really hitting hard at the beginning of each year. And then you can kind of, assume, maybe not assume, but trust that it's mostly in line with your wishes. But if things change throughout the year, health, family circumstances, work, other
marital status,
marital, like
kids,
all these different things,
all kinds of stuff,
can generate a reason to look at it
Yeah.
mid-year opposed to just the beginning of the new year. So the bottom line is, has anything shifted that should update the plan? Sometimes the most important financial review has nothing to do with performance, which a lot of the times people are looking at their portfolios and their assets and their wealth from that standpoint. How's performance been?
Yep.
But the most important sometimes can be not performance, it can be everything else that has to do with all the other ancillary parts of your financial plan.
If you're preoccupied with your rate of return, and that's what you spend most of your time doing, and you think that you're taking care of your financial plan, you're not. You're likely missing a ton of other stuff. Think about that 5 principles of financial planning we've spoken of previously. If this is your first time listening to us, then this will be new for you. But for many of you, we bring this up multiple times because it's so important. It's the backbone of financial planning. Yeah. The first is rate of return. Of course, that's important. That's table stakes. But if that's all you're paying attention to, you're missing all the others. The second's retirement income planning. Are you on track to generate the cash flow you need when you stop working? When the paychecks stop, what's going to replace them? We specialize in that. The third is estate planning, and estate planning is about dealing with your overall circumstance when the eventual death, disability, other circumstances can occur that ultimately require legal intervention, and you need to have good legal documents in place. We are often encouraging clients to have wills, advance directives, durable power attorneys, and sometimes a living trust as some basic documents that can make sense for a lot of people, though, again, we don't practice law, but we're happy to assist in facilitating getting that completed. Tax planning, which we already nerded out a little bit on that, that's obviously a huge part of keeping your tax bill down. Think about it this way. Remember that your gross revenue that's coming in? We were talking about it as net revenue after taxes, and then your expenses, we were trying to keep expenses at 80%. If you decrease your tax bill, you actually increase your net revenue. So you have a higher amount of money coming into you, and then 80%, that actually increases what you can spend. So if you decrease your tax bill, you might actually be able to spend more and enjoy life, which is actually okay. It's balance. That's how it plays out. And the last one, as Tyler said, is protection planning, which we've got health insurance, auto and home insurance, which we don't handle here, but we definitely want to make sure you're covered in those respects. That changes over time if you get a business or if you retire from a typical employment situation, or if you're self-employed. You have to really watch those things. And then the third stuff we do handle, life insurance, long-term care, and long-term disability insurance. And making sure you're taken care of there is important. For employees, long-term disability insurance is typically covered through your employer. Make sure you've opted in if you have to opt in. For self-employed individuals, it's often thoroughly neglected. Make sure you take care of that. Take care of long-term disability insurance, because you're 3 times more likely to get disabled before you retire than you are to die. So, though life insurance is obviously critical as well, and there's a lot of cool, fun stuff you can do with that.
Yeah. No, just as you're talking through that stuff, Tim, it struck me. Don't make the assumption that you have coverage. Don't make the assumption that your employer has that stuff in place for you. Ask, go to HR, ask whoever is your manager, say, I'd love a sheet that outlines the coverage that you guys are offering to me. Maybe you briefly remember that when you onboarded with them as a new employee back in the day, whether that was recent or a long time ago, but ask, and they are legally obligated to share those details with you. And then if you run your own business, you hang your own shingle, if you have to ask yourself, essentially, because you're the one that's in charge of that stuff. And if the answer is no, then it's probably being neglected, like Tim mentioned. So
cool. And you know when a great time is to do that? Right now.
Right?
It's your mid-year checklist time. So I think we've covered a lot of ground, Tyler. Is there more on your list?
The only other thing is just make sure your goals still match your life. So things change quickly. 6 months, like I said, can unpack a lot of things in that amount of time. Just make sure that your goals still match your financial plan and that it still reflects reality for you. Maybe you had a huge life epiphany after watching a movie or reading a certain book, and now all of a sudden you have a whole different outlook on what you want your life to look like. That's an extreme example, but it happens. And then make sure that your plan then evolves with those evolving situations from that aspect.
Yeah, align your goals with your life and make sure that they stay aligned.
That's right. That's right.
Well, we got to do just the answer. For those people who didn't watch the full version of the show, they get just a short little snippet of this. If you watch the full version, I have no doubt that you're getting a lot of ROI on your minutes, return on investment of your minutes, because there's a lot of really good stuff in there to take away. I'm sure we're not going to be able to get it all into just the answer. So
we'll give you the elevator pitch here.
Yeah.
All right. So Tim and I talked about what should be on your mid-year financial checklist. At a minimum, mid-year is a good time to review your spending, your savings, your taxes, insurance, and your overall goals, as we ended the large format of the podcast talking about. A lot can change in 6 months, right? We're no stranger to that. And if your financial plan has not changed with it, that can create drift without maybe realizing that it's happening naturally. So the value of a mid-year check is not that it has to be complicated, is that it gives you time to notice what is off while there's still room to adjust it. We talked about that with taxes and savings goals, insurance and protection planning. Now's a great time if things have drifted and maybe you're not on track with the original goals you set earlier in the year to fix those things, because you still have half the year remaining to make those adjustments.
Yeah.
So the best financial plans are not built just once. They are revisited as life continues to change.
That's right. And, and as always, look, I love consuming Netflix shows and, shows on Prime or Apple TV or any of that stuff. I consume a lot of them. I really enjoy the stories. In the time it takes to watch a sitcom, like 25, 30 minutes, you can listen to the full version of our show, and there's so much stuff that you can unpack in that period of time that we're not able to get into just the answer. So please feel free, consider listening to that. We covered a lot of ground in there, specific suggestions on what percentage of your income you should save and versus live on versus where your savings should go, paying attention to the 5 principles of financial planning. There's a lot of really good information that we have in a long version of the show. So I strongly recommend that if you're serious about doing a mid-year planning session, use that as a kind of a formulaic jump point so that you can just get things going. Listen to the full version of the show, download what we're going to share with you here in a little bit as you have that in front of you, and all of that will be helpful for you.
Tim stole my thunder. And for those of you listeners that don't want to listen, you just say, give me something and I'll go do the work myself, Tim and Tyler. We have created a free mid-year checklist for all of you that it covers the areas that matter most and identify what may need attention before the year gets away from you. So it's that nice bullet point type of checklist that you can just work through systematically and make sure that it aligns with everything that you have going on in your situation. So click the link in the video description below to get a copy of the checklist that many of our listeners have already gotten lots of value from using themselves.
That's right. It's funny. I'm just visualizing a cloud over your head with like lightning bolts, and I'm like stealing your thunder.
Yeah,
like,
there it goes.
Sorry, man.
Whoop,
Yeah. Anyway, sorry to stolen your thunder, Tyler.
No, it's okay. Trivia.
Yeah, hit me.
We're going to end with trivia as we always do. I'm going to butcher this word, but that's what I get for choosing this trivia question. Tim, I'd like you to tell all of us on the podcast, how many sides does a dodecagon have?
Oh, dodecagon?
Dodecagon.
I guess. That sounds right.
Dodecagon. There it is.
I don't know. Dodecagon or dodecacon? Dodecacon. It feels like a song, doesn't it?
Dodecagon.
I'm just gonna dodecagon. I have no idea. I'm just gonna say 100 because that just feels like crazy, but maybe
that would be cool.
Know. Sure.
I don't know if anything has 100 sides.
It's got to. It's conceptual.
Yeah.
I mean, eventually,
so some reality.
It's really like a circle that turns into like, think of like an octagon, and then take the octagon out with just little tiny little lines instead of perfect circle. That would probably, you can get to 100 that way.
Yeah.
Anyway, that's probably not what it is. So what is it?
It is 12 sides.
12. Well, that's way smarter and way easier than a 100-sided, shape. You could probably actually draw one.
Fits the podcast nicely because the year has 12 months and the episode's about stopping midstream to assess how the full year is taking shape before the remaining months get away from you.
It's dodecagons.
Dodecagon.
Okay, got it. I feel like it's dodecahedron a thing too.
I think so. Yeah.
Nice.
Yeah. Geometry was not my forte.
It was. I did okay, but it's been the 9th grade. That takes me back a long time.
Yeah, that does.
Thank you for joining us on Clear Money Talk. Until next time, we hope you're getting a great ROI on your minutes, enjoying our shows, and please don't forget to hit that subscribe button or share this with as many people as you can, or both. That's even better.
That's right. Yeah. Thank you for your time. We look forward to many episodes to come. See you soon.
Tim Claremont and Tyler Andrews are investment advisor representatives offering securities and advisory services through Cetere Wealth Services, LLC, member FINRA SIPC. Advisory services offered through Cetere Investment Advisors, LLC, a registered investment advisor. Cetere is under separate ownership from any other named entity. The views depicted in this material are for information purposes only and are not necessarily those of Cetere Wealth Services, LLC. They should not be considered specific advice or recommendations for any individual. Cetere Wealth Services, LLC exclusively provides investment products and services through its representatives. Although Cetere does not provide tax or legal advice or supervise tax, accounting, or legal services, Cetere representatives may offer these services through their independent, outside business. This information is not intended as tax or legal advice. All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. Examples referenced are hypothetical only and do not represent the actual performance of any particular investments. Converting from a traditional IRA to a Roth IRA is a taxable event. A Roth IRA offers tax-free withdrawals on taxable contributions. To qualify for the tax-free and penalty-free withdrawal or earnings, a Roth IRA must be in place for at least 5 tax years, and the distribution must take place after age 59 and a half or due to death, disability, or a first-time home purchase, up to a $10,000 lifetime maximum. Depending on state law, Roth IRA distributions may be subject to state taxes. Distributions from traditional IRAs and employer-sponsored retirement plans are taxed as ordinary income and, if taken prior to reaching age 59 and a half, may be subject to an additional 10% IRS tax penalty. Investors should consider the investment objectives, risks and charges, and expenses of mutual funds and ETFs carefully before investing. The prospectus, which contains this and other information about the funds and ETFs, can be obtained directly from the company or from your financial professional. The prospectus should be read carefully before investing or sending money. A diversified portfolio does not assure a profit or protect against loss in a declining market. Dollar cost averaging will not guarantee a profit or protect you from loss, but may reduce your average cost per share in a fluctuating market. Investors cannot invest directly in indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and the fees and expenses associated with investing. Although it is possible to have guaranteed income for life with a fixed annuity, there is no assurance that this income will keep up with inflation. There is a surrender charge imposed generally during the first 5 to 7 years or during the rate guarantee period. There is a surrender charge imposed generally during the first 5 to 7 years that you own the contract. Withdrawals prior to age 59 and a half may result in a 10% IRS tax penalty in addition to any ordinary income tax. The guarantee of the annuity is backed by the financial strength of the underlying insurance company. Investment subaccount values will fluctuate with changes in market conditions. An investment in a variable annuity involves investment risk, including possible loss of principal. Variable annuities are designed for long-term investing. The contract, when redeemed, may be worth more or less than the total amount invested. Variable annuities are subject to insurance-related charges, including mortality and expense charges, administrative fees, and the expenses associated with the underlying sub-accounts. Investors should consider the investment objectives, risks, and charges and expenses of the variable annuity carefully before investing. The prospectus contains this and other information about the variable annuity. Contact Clear Financial Partners at info@clearfp.com or 503-579-1000 to obtain a prospectus, which should be read carefully before investing or sending money. The cost and availability of life insurance depend on factors such as age, health, and the type and amount of insurance purchased. Before implementing a strategy involving life insurance, it would be prudent to make sure that you are insurable by having the policy approved. As with most financial decisions, there are expenses associated with the purchase of life insurance. Policies commonly have mortality and expense charges. In addition, if a policy is surrendered prematurely, there may be surrender charges and income tax implications. The target date of a target date fund may be a useful starting point in selecting a fund, but investors should not rely solely on the date when choosing a fund or deciding to remain invested in one. Investors should consider funds' asset allocation over the whole life of the fund. Often target date funds invest in other mutual funds, and fees may be charged by both the target date fund and the underlying mutual funds. The principal value of these funds is not guaranteed at any time, including at the target date. Cetere does not offer any direct investments, endorsements, or advice as it relates to Bitcoin or any other cryptocurrency. This is for informational purposes only. Bank certificate of deposits are insured by an agency of the federal government and offer a fixed rate of return, whereas both the principal and yield of investment securities will fluctuate with changes in market conditions. Clear Financial Partners is located at 15573 Bangui Road, Suite 100, Lake Oswego, Oregon 97035. For more information, please call us at 503-579-1000.